Give us a sense of the sort of feeling out there amongst market participants, because nothing goes in a straight line, obviously. This one has been going in a straight line. A lot of people have believed that it will continue to do so.
Yes, Rish, I'm not so convinced of that. And one of the reasons for that is the signals we're getting from markets other than equities. And in particular, the sell-off that we've seen in bonds suggests to me that what we're looking at is a sea change in markets. Now, this all relates back to the Fed's comments about yield curve control. And while that certainly was a good headline and a reassuring headline to come from the Fed, the underlying implication is that fiscal policy, increased fiscal support, will mean at some stage this year there'll be ongoing conversations amongst central bankers about how they go about a taper. Clearly, yield curve control is one of the tools that the Fed's examining, but the key point here is we may have seen the low for liquidity and for interest rates, and that has profound implications for all markets, but especially equities, given the stretched valuations that we see.
Are your clients getting concerned about A, valuations, and B, are those whispers in the background about inflation this year getting louder?
Yes to both of those. Although, to be fair, our clients have been very worried about equity valuations for a long time, Rish. A lot of traders come to the market with a natural bear bias, and that's been very costly for many of them, particularly over the last 9 months of 2020, where many of them were recognising very significant risks. And even if they weren't short the market, they failed to capitalise on the gains that we saw in equity markets. So those concerns remain. If anything, of course, they've increased. I'm not sure that inflation is playing as big a part in their thinking, in the traders' thinking, while it's certainly something for economists to kick around. For traders, until we start to see inflation towards or above the top of central bank bands, they probably won't be too concerned. A return to median inflation levels, those within expectations from central banks, won't concern them. And it doesn't seem likely, at least talking to traders, they don't see a likelihood that we'll see inflation breaking out the top of guidance bands this year.
Michael, truth of the matter is you have to keep chasing momentum. Forget the stretch valuations, forget concerns about inflation, which, it's not going to come in the foreseeable future. You can't afford to be a bear in such a market that's seeing records every other day.
Absolutely. And momentum, of course, has been the key investing style for at least the last 7 years, and was certainly the case over the last 3 quarters of last year. So that momentum style certainly has been imprinted, particularly on fund managers, and that will continue until it stops, of course. And a turnaround, a clear view from markets, or a consensus that we've seen the bottom in interest rates and the next mover upwards, might be the sort of a market event that could bring that an end to the power of the momentum trade, at least in the short term. Having said that, there's no evidence, despite the highly liquid environment, that value investing is doing much better than it has over the last 10 years as well. So at this stage, I'd have to agree momentum is the only game in town.
I'm looking at your calls. It says short stocks. Really?
Yes, absolutely. Short stocks by being long index puts. The reality is you can dust a premium, and the steady markets that we've seen, and that steady grind higher, has brought volatilities right back down to almost where we were pre-COVID. So that means all other things being equal, and they never are, of course, but all other things being equal, option prices are cheap. So the potential for portfolio insurance for fund managers, or for trading via trading short equities via options, is a very real strategic call. How that applies in the trader's individual situation varies, but at the very least, I'd be looking to stay neutral equities at current levels.
Mike, when we, had Bitcoin testing $40,000, it was a bit of a head scratcher. It's now, this morning, went below 30,000. Hugely volatile here. What are you making of this, and what do you make of it as an asset class?
Well, that's the big open question, isn't it? The experts in blockchain that I talk to tell me that Bitcoin will not be the transaction choice for the future. But in the short term, it's got the market leadership. And when as we're seeing greater institutional participation in crypto markets, almost all of that is flowing into Bitcoin. It's one of the reasons why it's maintained its leadership. But whether or not it has an economic value beyond a store of wealth is still a wide open question. Certainly the ability of blockchain to store data is a very important application, which might mean eventually blockchain technology is applied away from value, away from the currency markets that we're currently seeing. But in the short term, we expect to see further volatility in the cryptos. I note that of that move from around 17,500 to that top just below 42,000 US dollars, the 61.8% retracement is just below $27,000. So just in a standard sort of market approach after such a strong rally, a pullback to that level and possibly support at that level would not be surprising.